Right, okay, it's 11 o'clock. We should get going. Lots to get through this morning. So as we've flagged already, we're going to run probably slightly past 12, so please do stick with us. First off, some news from me. Dan McHattie is going to look at what happened over the course of March. And then I'll be talking to Dennis Jackson and Laura Foll from Lord Adventure. So, news first. Three things I pulled out of that's been happening over quite a lot over the last few weeks. I could have pulled out more, actually. There's quite a lot going on. But the first one, quite a big one. So AVI Japan Opportunities made an approach towards Fidelity Japan. And as we know, sort of hostile, I don't know, yeah, I think it is sort of hostile approaches are quite rare in the sector. They've basically been frustrated that they've been talking to Fidelity Japan and they haven't been listening. So they've gone public with what they do, and which is kind of what they do in real life in investing in Japan anyway. So you can see the chart for Fidelity Japan there. We talked about this last week, and I flagged how bad their results have been, and you can see just on the 5-year chart how bad the performance has been too, and how wide the discount's been. Currently 7.8, but that's currently in response to what happened with AVI. And the contrast with AVI Japan Opportunities chart is quite stark in that obviously this one has been performing quite well and the discount's been quite tight. But the discount's slightly widened yesterday, and obviously that's because of everything that's been going on, and Andrew's going to talk about that in a bit more later on. So if we look at the state of play, AVI Japan Opportunities is a little bit bigger and would dearly love to be bigger. So one of the things that the performance of all these things is quite lumpy. Nippon Active Value got going and very quickly got a couple of results. And that boosted its performance, and it was able to absorb a couple of other trusts that had AVI Japan Opportunity. It had been sort of reversed, then AVI Japan Opportunity probably would have done that. So they're slightly lagging. I do think they deserve to be bigger. And Fidelity Japan and maybe Barely Gifford Japan are the obvious targets for it. These are the return figures, and you can see the stark contrast there in terms of what it's been delivering, and particularly recently over sort of 1 and 3 years. 5-year numbers, remember, are a bit weird at the moment because of they sort of go straight back to COVID. And then just to recap from last week, so Fidelity Japan underperformed its benchmark over 2024 by quite a lot, had to buy back a lot of stock. The manager's retiring, so that sort of unnerves people anyway. But the board wanted the managers to have a chance to get through all the way through the into a cycle. And so they said, we will give you an exit, but not until 2028. I made the point last week that other growth managers like JP Morgan Japanese are actually doing quite well now. So maybe this is just about stock selection and not about the value versus growth debate. What happened on yesterday? AVI has made a merger. It's approaching in sort of normal kind of Section 110 merger. So we've seen lots of these recently. I've talked about lots of them already. This one will have a cash exit for shareholders up to 25%. Importantly, because you remember that the exit was in 2028 for FJV, if you went down this route and you didn't want to hold it at all, you could get out everything in October when AJOT has its annual redemption mechanism. Crucially, the biggest shareholders on side, they would quite like to see this deal go through. Obviously, they're a discount player, so whether they hold on or not would remains to be seen. Nevertheless, we'd still expect the fund to end up being a lot bigger than it is now, which is good. So big more liquid fund, big tick in the box. And that also ought to bring down the ongoing charges ratios too, so they're more in line. And then there was an obvious uplift in terms of discounts when they made that announcement, and then obviously everything got derailed yesterday. But we expect that kind of gap to re-emerge if nothing happens. So Fidelity Japan responded this morning. It said, yes, we did get an approach in August and we rejected it. That's unfortunate for shareholders because had they done it and you got the whole thing done by early October, which maybe that's slightly ambitious, but it was easier to look up 6 months numbers than try and do something, say, in November. And it's quite a big difference in terms of what you would have had. in AJOT rather than FJV. They also say, well, we've delivered substantial outperformance in the past and stick with us, and that might happen again. But I would point out that its long-term numbers, the 10-year numbers, are the lowest of the peer group. So I don't think that's a defense, and I don't think it's something that they can stick to. They also say that the obvious thing, that it's quite a different style, because you're going from growth stocks to value opportunities. But AJOT isn't investing in value stocks, it's investing in decent quality companies that are lowly valued, and that's not quite the same thing. And so I don't think you're necessarily giving up the kind of growth of the Japanese economy in there. And also, although we're talking about cycles here, AJOT doesn't see that there is a cycle that's going to end very soon. This is a sort of secular trend in terms of improving corporate governance, and that could run for many years yet. And if the story ran out, I'm sure they'd be thinking, saying differently. But at the moment, they say there's quite a long pathway for this. And then, yeah, we talked about the tender offers already. So that's the end of that one. I do think this is not the end of the story. Fidelity Japan is going to have to do something, and I expect that AVI are going to come out and actually make a formal proposal. That's what I'd like them to see anyway. VH Global Energy Infrastructure next has been a bit of a disaster in terms of the share price. It's not uncommon in the sector. The discount's enormous now, 45. The yield's about 10. That's not the highest, as we'll see in a second. And you look at that chart there where it's there at the bottom. It's one of the widest discounts, but not one of the highest yields. That's not the sort of way that they run. They're sort of slightly trying to drive some NAV growth as well as income. So it's a total return type objective. The ongoing charges ratio is relatively high. That counts against it. And the market cap isn't very big, but obviously that's not reflecting that enormous discount. And in terms of the performance numbers, it's a bit too early to tell. So this was only launched in 2021, and it's only just getting going. But obviously the NAV hasn't been spectacular over that period, but then neither has everything else. So results that were announced yesterday, the NAV fell 6.5%, the share price fell 4%. The dividend wasn't quite covered. So all of these things you'd think slightly worrying. And the discount was already wide and has widened since. And they were doing a buyback, but they'd run out of room on that. The plus point was that the gearing was relatively low. So they could do something with that in future. The board has obviously been concerned about what's been going on with the discount, and it's been talking to major shareholders. So they kind of flagged that they were doing this for a while. The feedback was mixed. So some people, I think probably along the lines of, this hasn't been going very long, you seem to be doing okay underlying, and let's keep it going. And others more like, well, I've seen this thing dive, I do want my cash back now, or at least some effort at buying back stock to drive the discount down. So the board is evaluating alternatives to what it can do to try and then address that. And the wording is ambiguous, but it's sort of inviting approaches, I think, exploring all options. I do think that sort of puts it in play. The next continuation vote isn't until May 2026, so they're obviously trying to preempt that with some kind of positive development in terms of maybe selling assets to buy back stock or tie up with somebody else. We'll have to wait and see, but they're obviously trying to preempt that. In terms of what they've got, it's a very globally diversified portfolio, and it's got exposure to Brazil, which nobody else has. It's got a big exposure to the US, but that's in one asset that we'll just see in a minute. And that is unique in the sector. There's nobody else that has quite that kind of geographic diversification. And then in terms of what sorts of assets they're investing in, that's pretty diversified too. And again, unusually diversified. And the big asset is that one in the US, the terminal storage one. which sits on the border with the US and Mexico and is importing Mexican oil, refining that, and then selling it on. That was a worry for some people. It was a worry for me, but actually we had a conversation after the previous sort of announcement they had made on this. And they are adamant that tariffs are not going to have an effect. And the full kind of statement is there. You can read it. Basically, it's the sort of argument is there's nowhere else for this oil to go. It has to go this way. So even with the tariffs, the thing will still keep going. And this is revenue based on the usage of the storage terminals rather than any kind of profitability on the oil. So that does kind of stack up. But nevertheless, I suppose that's unnerved some people. I think that the diversification element of this means that it's not a bite-sized chunk for anybody. I don't really see that a bid is going to come along for the whole portfolio, but that doesn't mean that people won't be interested in bits of it. It doesn't mean they can't sell off some assets to fund buybacks. It's very different because it's got no exposure to subsidies at all. All of the income, though, is quite predictable because they sell power forward to reduce the impact of power price volatility. So they've got quite long-term visibility on income. And they've got a lot of the portfolio construction stage assets. That will fall quite sharply over the coming year because there's lots of stuff that is almost finished. That's sure to provide some NAV uplifts, and it will definitely improve the dividend coverage. I do think that dividend cover thing is not going to be a problem going forward. So all of this is sort of saying, I can't see that somebody's going to bid for it. I do think that the underlying portfolio is improving equality and doing okay. And I kind of see that this is a sort of self-help thing rather than somebody coming along from outside, but that doesn't mean that we'd necessarily rule it out. European assets, I just wanted to focus on this one because this one's been a disaster for a long time. And you can see that on the chart there. And you can also see that it's a reasonable size, but it's not very big in the context of the European sector. And the performance has been pretty dreadful for a long time. And the results that it published yesterday were poor again. And the long-term numbers are really dreadful. I mean, you look at the 10-year figures and how far they are behind the benchmark, that's enormous. It pays out a dividend of 6% of NAV. Obviously, if the NAV is going down, all you're doing is cannibalizing the capital of the fund. So that's not good news. And because the NAV is going down, the dividend's going down. So that's disappointing if you're an income investor too. It's not buying back stock. And this kind of brings us back to a debate we had about Oakley and share buybacks versus dividends last week. So should they just cancel this and buy back stock instead? But the discount isn't enormously wide, only about 10%. So that's not really the problem here. The problem is the underlying performance. And the board is recognizing this, and there's quite sort of punchy language here. And they're talking about disappointing stock selection. They've made some changes. The fee was cut in January last year. The management was changed in May 2024. We're monitoring the impact of that, says the board. I think there hasn't been an improvement so far that is worth latching on to. So I do kind of think that this is now a big target. It's a really obvious thing to get taken out. And the question is who could do it? If you wanted to keep the yield and stay in Europe, then the obvious option is to go for the JP Morgan European Growth and JP Morgan. But obviously, if you did that, you'd lose the small cap exposure. If you wanted to keep the small cap exposure, I think the best opportunity would be to do a sign of deal with Montanaro European. It's got that new interval structure again that we talked about last week, which should help control the discount. But you would lose the yield. So the question is, do you want yield or do you want small cap growth exposure? The obvious thing you could do is for a joint bid by two of these companies, maybe these two companies, and people just choose which way they want to roll over to. but I don't think this thing should continue as it is. I think it's failed and it's time to go. So that is enough from me. Let's now talk to Andrew.
Great. Thank you very much, James. There's certainly no shortage of corporate activity for you to talk about. And of course, it's been a very lively and exciting month in the markets. I mean, I think that's a charitable way of putting it. We could
Sorry.
probably do with a lot less of that excitement. I mean, it was already a dramatic month, actually, with declining markets before Trump's tariff announcement, before the economic vandalism really got going. Actually, just on that topic, I mean, many years ago, I studied economics and remember vividly that economists struggled to agree on anything. But the one thing they did agree on is that tariffs hurt everybody in the end,
Yeah,
and that
I
free
think
trade actually secures the best allocation of resources. But there we are. That's a topic we could go on about for a long time. So let's have a look at the market and what's actually happened. I think it's quite encouraging, actually, that even against this very difficult economic background and very difficult market background, there were quite a lot of good rises in the sector. And these are principally actually because of corporate action. So we've got quite a few double-digit gains here. You can see there's a lot of REITs on the list and also the battery storage, which I talked about last month. And the overriding theme here, undoubtedly, is a corporate action. So Care REIT attracted a bid that I thought was actually quite a good bid at about a 9% discount to NAV. The news finally came through for Harmony Energy, where we had competing bids for the assets, which was really good news, not just for shareholders in Harmony Energy, which had a big uplift, but also for the other two battery storage trusts, which was anticipated really because they were so much out of favour in trading on these mammoth discounts. And then we've seen a lot of action actually both realised and forthcoming, I think, in the REIT sector. So Warehouse REIT has finally said it is minded to accept the latest of a series of bids that have come in from Blackstone Europe. Life Science REIT has said it's entering a strategic review. Supermarket Income REIT has basically left the sector now by internalising its management. Urban Logistics REIT wants to do the same thing, but that's now being attacked by Achilles, so we'll see what happens. And a little further down there, Premier Miton Global Renewables is also intending to wind down. So there's a great deal of corporate action going on. I think we can just expect that to continue. But it is delivering actually quite good gains for many shareholders. So I think there's a lot to be said to focusing on this and to making sure that you do stay abreast of the news. Because I think if you can skew your portfolio a little bit without being overly speculative, skew it to some of these interesting situations, you can actually do very well. And I'm delighted to see such a good outcome for Harmony Energy. So that's the risers, really. The fallers, I think, possibly more interesting this month. And certainly there have been quite a number of sharp falls, exactly as we would expect in these market conditions. The investment trust sector has not managed to resist these market falls. I mean, it's really fallen very much in line with world market indices. So there hasn't been very much in the way of protection. And amongst this list here, there's a lot of big names, a lot of well-known names. The overriding theme, again, there's one very clear theme, which is the exposure to the US. Of course, you've been very well served by having big US exposure over the last few years. And now that's coming back to bite a little bit. I think all of these ones here I've highlighted in red are largely exposed to the US. That's where their portfolios are. And the US is clearly, it was already in a corrective phase before this latest down leg. It's possible this might turn into a fully fledged bear market, but we'll have to wait and see. Of course, Vietnam holding also at the top there has been very much impacted by the tariffs. And I think if you want to read a little bit more about the tariffs, actually, there's a really good article on the Economist website, which I think is free for everyone to read. It's a really excoriating rejection of this tariff policy, but that's obviously impacting Vietnam quite a lot. And we've seen that Vietnamese specialist trusts all come out with statements actually about the impact of tariffs. So anyway, it's a bit of a grim picture that we're looking at. But I think, there's some interesting things to look at in the market. Maybe instead of talking about these really obvious themes, I'll talk about valuations and what shifted in the market. Because actually, when you do get these really volatile periods of market turbulence, they often throw up really interesting opportunities. And of course, at the present time, with investment trusts generally being quite lowly rated and on an average sector discount of 16.3%, there are quite a lot of good discount opportunities available. And one way of looking at those is to look at Z scores, which place the current discounts into context against their 12-month averages. So I've had a look at those and come up, I think, with some interesting trusts that look expensive or cheap at the current point. But just to put that into context, I'd just like to reprise a chart actually that I showed you a month ago, which was a 6-month chart showing the European markets in blue against the US markets in yellow here. And you can see there was this inflection point around the start of the year, actually, where I think investors were already switching out of the US and taking profits on some of their technology holdings in particular, and they were switching some of that money into Europe. And I think there was quite a strong argument, actually, that in particular with this massive increase in defense spending that we're seeing in Europe, that's potentially quite a big fiscal boost. And so I think there has been actually some switching of positions and manipulating of portfolios as investors come back into Europe. And we can see that in some of the discounts. So if we just flick on now to the relatively expensive part of the market, and these are some of the trusts I think where the discounts have been narrowing, there's an obvious theme here with those top 4 all being European equity trusts, where the discounts have all come into single digits from double digits. And James was just talking about Montanari European, which has obviously had a corporate maneuver to try and narrow that discount. But we've seen this happening anyway across the sector. And I think that's very helpful. It's been good news if you've had these trusts. But also, I think it removes part of this problem, this argument that actually all of the discounts are too wide at the present time. In my experience, that's not true. I mean, I think many of the equity discounts are perfectly reasonable. And if these are, high single-digit discounts, that's okay with me. But those have all narrowed, I think, just indicating that investors are genuinely shifting some assets back into Europe now, having ignored it for some time. There's 2 more at the bottom there that I think are interesting that stood out to me. One slightly curious one, I think, is Invesco Select Global Equity Income, where the discounts really come in, actually, from a 12-month average of 9.3% to just 0.2%. And I'm not sure why that is. I mean, it does have a 4% holding in Rolls-Royce, and there is quite a lot of interest in defence stocks at this time, and that could be attracting investors. But it's not unique in that, and I'm not sure that's really the reason. I think the other one, Temple Bar, is maybe a bit more obvious, where the discount has halved from 6.6 to 3.2. And I think that's really because there's been a resurgence of interest in value investing, and Temple Bar is certainly one of the trusts that really focuses on that. And I think as investors have backed away from their risk on positions and backed away from growth, so they're having another look at value investment and seeing that that's actually probably a better place to be at the moment. That's why Temple Bar, I think, has gone up. So those, I think, are the relatively expensive ones. Let's move on to the cheap ones. And I think there's 3 groupings here. The top group is still private equity, which we've been talking about for such a long time as being an interesting sector on a big discount. And, you'll remember that the board of Pantheon International was very widely feted by the industry last year when they announced their, very big buyback program to try to deal with the discount. And at the time, it seemed to have quite an impact, actually, and that was considered a really excellent maneuver by the board. But I think you'd have to say that discount's just come back out again, and it hasn't really worked in a longer term perspective. So the discount there has come back out to 43%, which is 8 points wider than its 12-month discount. Similar thing, actually, even wider for Apex Global Alpha. And generally, there is quite a lot of value about in the private equity sector still. I was interested this week to see that ICG Enterprise Trust actually sold a group of assets, a portfolio of assets at a discount in the secondary market. I think the discount was about 5.5%, so it was quite small. And that compares with a 35% discount on its share price. So there is still this big disconnect, actually, between what you're seeing in the secondary market for private equity assets and then what we're seeing in the public investment trust market, where the discounts are much, much wider. So that opportunity still remains, even though we've been talking about it for a long time. The next group, I think, are two trusts that were very highly valued and have probably just come off a bit. Odyssean actually has come back to a discount, having been on a premium, and I think maybe that's because its performance has softened a little bit. The other one I think is really interesting, JP Morgan Global Growth and Income, very much a flag carrier for the investment trust mergers. And it's taken in maybe 3 or 4 different trusts now. It's been growing inside. It's been very popular, often on buy lists, often at the top of the list of shares that private investors have been buying through the platforms. And it's had an average premium over the last 12 months, which has been very useful for it in conducting these mergers. But it has fallen to a discount now. And to me, I think that's completely justified because this is a trust that pays part of its dividend out of capital. And that's enabled it to actually skew its portfolio away from some of those value-oriented holdings that do pay high dividends, and it's had more of a growth bias to it, which of course has been helpful over the last couple of years. And that's why it's done well. That's why it's been attractive to people. But now I think that's maybe turning from a tailwind to a headwind. So, it'd be interesting to watch that one. I'm not sure it's going to stay in favor quite as much as it has. The two I'm going to focus on at the bottom, and I think these probably span the risk spectrum quite well. So you have Augmentum Fintech very much in the growth capital bucket. It's fallen to a very big discount now, over 50%, which is against its 12-month average of 38, which is quite wide anyway. But I think this again reflects this massive risk-off position that investors are now shifting to. They're nervous about markets. They're not sure that IPOs are going to take place. They're not really in favor of unquoted investments at the moment. So that's all hurting this trust. And then at the other end of the spectrum, you've got international public partnerships, big, fairly conservative infrastructure trust, again, trading on a wide discount now of 24.8% against a 12-month average of 18. So let's just have a quick look at those two. I'll just call up the charts. So Augmentum Fintech, first of all, you can see here with the green line, its NAV has actually been quite steady, quite decent. A really not bad NAV performance at all. But the share price has been coming off, and hence the discounts widened out. I'm not going to say too much about it, but I just wanted to put its objective up on the slide here, because the key point here is that although it's investing in these small early stage fintech companies, where I think the UK really does have an advantage, by the way, but it's investing in companies that are predominantly in the UK and Europe. So it really doesn't have US exposure. So I don't think this should be impacted by tariffs. Financial services are excluded anyway at the present time. But I don't think that's really why it's come down. I think it's just part of this general sell-off. And I think that this is where anomalies arise sometimes, that all of the stocks go down together, regardless of the underlying merits. So I think that's interesting. And then at the final slide, at the other end of the risk spectrum, is international public partnerships. Again, fairly steady NAV here. You see it's a jagged line because that's of the regular payment of dividends. And it has been slightly negative, and that's probably really because of bond yields rising, because the discount rate has been going up here. And this trust is very sensitive to bond yields. I think these big infrastructure trusts are seen as bond proxies, and certainly that's an alternative for investors thinking about these. They can just put the money into gilts instead. So when bond yields are rising, that's bad news for the share price, and that's what's happened of late. But I do think it's really interesting. If you look at the steady state percentage of growth here, it's actually very good. Stockbrokers calculate that, and INPP is one of the very best in the sector. And it has an attractive dividend yield of 7.5%. If you buy it now, you will get the next dividend. It goes ex-dividend on the 24th. And I wonder whether this is a decent place actually for investors to park some money if they're nervous in the short term about the volatility of equity markets, and you're looking for investments that actually are somewhat away from that growth sector that's been so fantastic for the last few years, but you want to shift some money into something a bit more sensible. This is a possible shelter. I mean, it's hard to say anything's a shelter. Most things are going down at the moment, but I do think this is worth looking at. Okay, that's it, I think, James. I'll hand back to you.
Thank you very much, Andrew. That's great, actually. And I would point out on that thing about the bond yields that the ages the US and UK bond yields have been tracking each other, but the last couple of weeks there's been a big divergence. So US bond yields, 10-year bond yields, are now down below 4%. And that ought to be good for IMPP, which has got some kind of overseas assets. But actually, the UK ones are still sticking up there at sort of 4.7-ish, something like that. So, yeah, we'll see.
It's interesting, and just one quick point there. You could argue that if the tariff impact is to slow global economies without introducing too much inflation, then that could encourage more interest rate cuts. And I have seen that actually postulated in the press. So that could be actually quite positive.
We had one question while all that was going on. Why is Gore Street down this week? I think nothing obvious to you.
There's nothing in particular. It does have some US assets, and that could well be the reason. I think as well a little bit of profit taking because it had risen before. So there's nothing I'm aware of to be of concern there.
Me either. Brilliant. Thank you very much, Andrew.